Welcome back, students who are taking financial accounting, and in this series of videos we are working on the chapter 4 short exercises, and we're going to pick up with problem 4 short exercise 4-10, and I'm going to skip the usual spiel here about um, if you don't understand something, contact an instructor. Go back and watch 4-9 to see my full, the very start of it, to see what I think about and understanding the material and having to contact an instructor. So let's just begin with 4-10 here. Give you all a break from my spiels, my rants. All right. Anyway, so it says here, calculate the classified balance sheet amounts. All right. So we have select account balances at the end of the month, and they're listed in random order. All right. So even though these are accounts and their balances in the accounts, which would be a trial balance, they're not in the correct order. All right. So we're going to have to hunt and pick for, the information that we need. All right. So it says identify or compute the following amounts for Maria's Mocha. Right. A is going to be our total current assets. Right. So, what are, first of all, we have to be able to identify what our assets are. Okay. So, let's see here. Equipment is an asset, inventory is an asset, accounts receivable, accumulated depreciation equipment, supplies, building, cash, accumulated depreciation, prepaid rent. Okay, those are our asset accounts, right? But you don't just go down through and add them all up because we're asking about our current assets, right? We're not talking about the long-term assets. So what would be a current asset? Well, obviously cash, and that is $6,400. Then next on our list would be accounts receivable. And notice that accounts receivable, 5,700. When you're creating your chart of accounts, and also when you're looking at your, balance sheet, you list your accounts in the order of liquidity. All right, liquidity meaning convertible to cash. Cash is the easiest account because it's obviously cash. You can't change it into cash. It's already cash. But then you'll have like marketable securities, and then you'll have like accounts receivable, then things like inventory. In this case here, inventory is 27,000. Let's see here. So let's do it. So we get rid of inventory, get rid of that, get rid of that. Okay, so then the next thing would be something like supplies. That would be current, and that's 1,950. And prepaid rent for $2,400. Okay, so that's current. Then after that, the next would be something like, when you're listing things in order. Now, we would have equipment next. And then, of course, accumulated depreciation for the equipment. Let's see, we had supplies. And then long-term, we have building and accumulated depreciation for the building. Right, so this is the way we would normally list our accounts in the order of liquidity, meaning it's relatively easy for us to convert accounts receivable into cash. We can just call up and ask them to send us the money, or we wait 30 days. Inventory takes a little bit longer to, convert into cash because obviously you have to sell off your inventory, but you can sell it off relatively quickly if you deep discount it. Same with supplies. That's something that you can deep discount. Prepaid rent, again, you can call up and have the who you paid it to, refund that to you, but it might take them a week or two to do that, or depending upon how much, it might take them a little bit longer. But then equipment, you know, depending upon the equipment, very similar to inventory. You'd have to deep discount that, and of course, selling a building, takes a really long time. So you're listing these things in the order of liquidity. Now the question becomes, what are our current assets? Well, current stops right here, right? These are things that can be converted within easily within the now and the next 12 months. Okay, and so if we add these up, we end up with a total of, let's see here, 0, 5, 4, 3, 4. $43,450 would be our total current assets. Okay, so $43,340, $43,450 are our current assets. And I just want to take and stop for a moment to notice that there's a difference between current, if you remember from math, there we have what's called a current ratio, which is current assets over current liabilities. Okay, that's your current ratio, but we also have this concept of a quick ratio, right? And you have to pay attention to that because quick ratio is not current assets. It's even though it is over current liabilities, it's your quick, and that is the way I like to think about it, your quick assets, meaning what can be converted, really, really quick, all right, into cash, right? So it's going to take some time to sell inventory and supplies. So quick would be cash and accounts receivable, right? And you treat those as quick assets over your current liabilities. And again, there's a little bit of play here as to what you would include and what you wouldn't include, but I want you to, since we're just talking about current assets, I want you to realize that if we were discussing current ratio, also there's an analysis tool called the quick ratio. Okay, how much cash can you get real quick in order to pay off your current liabilities, right? Versus taking a little bit more time. It's going to take some time to sell off your inventory and your supplies and get your prepaid rent in order to pay off your current liabilities. But these are measures of liquidity ratios, and in order to be able to see if you can pay your bills on time, right? So that's the answer to number one, is 43,450 for current assets. Now, current liabilities kind of works the same way. Okay, what you can pay off really, really quick. All right, so let's see here. For current liabilities, right, we have an accounts payable. Let's see, first of all, identify our liabilities: unearned revenue, salaries payable, notes payable. Right, let's see here, we got rid of the building here, accumulate depreciation building, equipment, all right, and so we have accounts payable, unearned revenue, salary payable, note payable. They're our liability accounts. But what are our current liability? Well, accounts payable is $14,800. Unearned revenue, all right. Well, salary payable actually would be next when we're creating our chart of accounts or our list of accounts. 2,150, and then next would we get the unearned revenue would be 7,300. Okay, so those are current. Note payable long term is not current. Okay, that's long term. So the total of those ends up being, let's see here, $24,250. So that's the total current liabilities. Okay. Now the next question asks, the book value of plant assets. Okay, so what are our plant assets? Well, our plant assets are equipment and accumulated depreciation, and building and its accumulated depreciation. So we have equipment, which is 43,000 less the accumulated depreciation of the equipment, which is 4,200. And so that would give us $38,800 for the equipment, and for the building, which is 121,000 less the accumulated depreciation of 53,000, gives us 68,000. Okay, and let's see, it's the book value of plant assets. So those are the book values of those plant assets, and the total would be, the 68,000, the 38,800 plus 68,000 would give us $106,800 as our total book value. Okay, it's only asking for the book value of the plant assets, and I realize that the solution is showing it in a slightly different manner, and that's just a matter of interpretation here. Okay, as to whether you would have a total book value or you're just looking at the book value of individual assets. Right? And now lastly, the total long-term liability. Well, that's simply this note payable long-term liability. That's the only account. So the answer to that is, the 46,000. Okay, so that's it for 4-10, and I will see you in the next video for 4-11.